And then let's see what we have. So we talked a little bit about this on the Discord, right? I was eyeing obviously VIX, but really VVIX all of last week, because I think this is giving us a ton of information at the moment, a lot more than the rest of what's happening at the moment in the marketplace. That was the big focus of the newsletter on Sunday, with that subtitle, not so subtle. Have you noticed? VVIX closed around 85. It's been trading below 90 for most of the week. And basically since May last year, this means really the lowest percentiles. So when you have stuff like this, when you have prices like this, and if you're new to quant trading and data analytics stuff, one of the mistakes I would say that some people would do is, okay, let me just take a price of VVIX over the last year or so. Let me build an average. Let me build a z-score, or let me just simply build a percentile like that one. And then, well, it's really low, right? And because that stuff is mean reverting, kind of, I mean, more than kind of, it's mean reverting, it should come back, right? And then you start finding every single explanation in the marketplace as to why volatility is too low. So in that case, volatility is too low. And you start to convince yourself that, well, that stuff has to go back to 85, 95, sorry, potentially 100. Um, Spoiler alert, it doesn't. It doesn't have to go to 100. It can, but it doesn't have to. It can mean revert and potentially go back to 90, 95. But the process of mean reversion, from a data perspective, you can still include a drift, right? If you want to really ignore what's happening at the moment in the marketplace, and we'll switch that to that in a second, it can still drift down, right? Like what was a average of about 100 up until about 2 months ago, can over time quickly becoming 95 and then maybe 90, and you see 82, 83 next week potentially. And then it's going back, mean reverting to 91, 92. But you haven't necessarily refrained your mindset and be thinking that those averages, those numbers, the problem with those averages is you only see them, well, first of all, with past data. So we build them as we speak. So it's only after a couple of extra days or extra week that you're going to have confirmation that, like, yeah, that new average is actually 91, 92. Obviously, you compute that average right now at the moment and you see now it's 92, but there's a part of you that's saying, like, yeah, but maybe it's an artifact of the data. Maybe we haven't seen all the catalysts played out. And maybe actually it should be more 96, 97. And then you need a couple of extra week of confirmation to see that, like, no, that new regime, you have an average of 92, 93. And when you know what VVIX looks like, the long-term average of VVIX is literally around 90. That curve of VVIX here, that distribution is interesting because we don't necessarily see it well. So that's since 2007. But in practice, VVIX, the distribution is much more bimodal. So it's either when nothing happens, it tends to average around 84, 85, where we are at the moment, even sometimes below that, right? Really around 80. It's not unusual to see VVIX in the low 80s and then stay there and then go to 70, go back to 82, that kind of stuff. And then you have a higher average, which is much closer to 100. And that's pretty much, and those two modes really characterize two regimes in the market, one that's fairly quiet, uh, or at least one where the risk perception, I much rather describe it like this, like where risk perception is lower, and another one where risk perception is higher. Because at the end of the day, VVIX is nothing else than buying insurance on where VIX might be over the next 30 days. And obviously, if you have a lot of people buying VIX insurance, buying VIX calls, so much so that the price is about at 100, you can understand that the risk perception in the marketplace is high in comparison to situation where The average, the long-term average, at least medium-term average, let's say, let's take about 1 year out, is more around 80. The risk perception is obviously lower in that circumstances. But I go back to what I was saying a few minutes ago from a pure quantitative perspective. The markets just switch regime. You have people that are now aware of the risk in the marketplace, but not willing to pay as much insurance as they used to. The market has shifted, risk perception have changed, and we are building that average as we speak. But it might take us a long time to see that, like, yeah, it has drifted down, and now it's already back to a process where the average is probably more around 90 or 91 or even 85 or something like this. Um, and that switch is what I'm trying to get you guys comfortable with on that goal. I don't have a crystal ball, as you guys know. I have no idea if indeed VVIX doesn't go back up to 100, 105 next week. All I'm saying is for it to go back to 105 next week, it means that you will need a bunch of market participants to show up and start buying the VIX calls again. VIX calls are notoriously expensive, right? It's probably some of the insurances in the marketplace that are the most expensive. So you will need to convince a lot of people that all of a sudden there is a very important catalyst that can happen within the next 30 to 3 months, let's say, to justify them to buy that stuff. And you look at the next 3 months, summer is around the corner. I know about inflation. I know the problem around oil and stuff like this. Um, I hear the stuff around the AI bubble like everyone else. The marketplace, the entire marketplace is aware of that, but the people that have big money at the moment, the one that are even more important than dealers, right? Everybody talk about dealers, but dealers at the end of the day, they only sell insurance. The real people that are market movers at the end of the day, it's the customers of these guys. It's the people that are buying those insurances. And if right now they don't buy them anymore, whatever we may read on social media, the press, FT, all that kind of stuff, doesn't mean it doesn't exist. It just means that maybe it is amplified a little bit too much, and you have that disconnect between what you can read in the press and what the actual risk perception is. So once again, it's a bit of an exercise in the continuity of what we said the last few weeks, where be careful between the spread that you observe with the level of fear or excitement or concern that you may read on social media and the press, and what the subtle clues, I mean, that are not so subtle anymore, that the market are giving you. And I mean, why not so subtle? Again, we haven't traded here for about a year. Sure, we can revert back here or even here, which is really much more the average of what we've seen over the last year. But you will need to find a very, very strong justification. Um, so yeah, that is to me the one important cue and important development that I will keep paying attention to over the next 2 weeks before we really transition into a holiday regime where realized volatility is completely disappear, completely gone, or almost, although it's already pretty much the case. We'll see that in a second. VIX is low too, obviously. Don't pretend to speak as much about it as VVIX because at the end of the day, VIX 15, it's low, but we've seen it since December. It's still obviously lowest percentiles, right? It's not unusual to see VIX 15. I think it's a little bit more unusual to have seen VVIX 85, considering everything that has happened since Trump got president. A little reminder, VIX 15 is low, but in the grand scheme of things, it's not horribly low as well. Because we're on the sell side of volatility most of the time, the combination of these two things, at least from my perspective, for a volatility seller, you need to understand that your risk, when we're here, your risk is not really there, right? If you pay attention to that and you say, okay, the market perception of risk is shifting, people are willing to pay less for insurance. They don't really want to like all those expensive contracts that decay over time. Your risk is not, obviously it's always there when you sell vol, but it's more to see that stuff keep going down because it can. And that's something that people trading volatility or trading market in general are quite uncomfortable with. Yes, VIX can keep drifting from 15, 15 and a half to 12 and a half. And when you sell volatility, VIX 12 and a half is not, it's not fun. We'll see in a second why, although if you've been reading Sharp 2 and you know Sharp 2 for a while, the answer is pretty obvious. But that is to me a much bigger concern to see VIX erodes over the next couple of weeks than it going back to 17, 18, even 20. In fact, I'd be very happy that something comes up and the VIX go back to 18, 19 over the next few weeks, whatever, and then keeps drifting back to that 15, 14 or whatever. But if we go to 12, I'll be a little bit annoyed. We haven't talked about that ratio in a while, and in fact, for good reason. It's right in the middle of things. It's VVIX and VIX, right? There's nothing there, right, at the moment, despite the fact that both of the, I mean, really the VVIX distribution is going back to what is considered a little bit more normal, or at least a regime where risk perception is much lower. We're right in the middle of that range. Definitely not the moment where VIX scores are more expensive than SPX puts. It's more situation like that one. It doesn't mean you can't sell VIX scores to buy SPX puts, but it's not necessarily a free trade at the moment. So that's it. We won't be talking about that one too much. But again, yeah, if you haven't noticed this, pay attention to that. Now, why is my risk in my from my perspective? And again, I preface that on the fact that most of the time I'm selling options, I'm selling implied volatility. If you have a different type of strategy, and I try to do that market neutral as much as possible. If you have a different strategy, like obviously you can have a different viewpoint than me. It's a free market. It's fine. I respect everyone's opinion. But at 15, you still have about 4 or 5 points VRP, which is uh, it's obviously not 6 or 7. I'd much rather have 6 or 7. So obviously any spike to 18, 19, I will be selling them without even thinking of what is it this time that the press is talking about. Obviously, I will pay attention to what it is, because if it's a news story about, I'm not in Dubai anymore these weeks. I'll still be annoyed if there's missiles flying in Dubai, but I'm not about it. So at least I'm feeling a bit safer. But yeah, if you have that sort of catalyst, obviously you want to pay attention to it. You want to pay attention to anything that's potentially going to, uh, yeah, bring realized volatility back from, this is where we are at the moment, 10 and a half over the last 30 days, back to something like this. Again, you need to have the right type of catalyst. If tomorrow you see something that brings back implied from 15 to 18, that can be the beginning of one of those catalysts. But again, it's unlikely because it's usually hard to take the market completely by surprise, especially now that Trump has been there for almost uh, not even 2 years, year and a half. For a year and a half, it's hard to take him completely by surprise. There's something else that's shifting in the marketplace. You start to see a lot more talk about like big IPOs. It was supposed to be one of the Trump promise, like not to say that it's a guarantee things will happen, but maybe this is what the market's gearing itself for at the moment. So yeah, if you see 18, make sure that the world is not on fire, but otherwise 18, that's 8 points. 8 points when your realized volatility is at 10 and a half. Um, the last 7 days, it's been at 7.5. That's really not a lot. So obviously that number has one day less because Monday was a day off, but it's consistently above 10, right above 10, and I suspect that as we get into the holidays, that number is going to drift back to numbers that looks like well, that was last summer, right? And in the middle of the summer, you had numbers like 7. So if you think that the markets right now are boring, wait until you remove 1 or 2 more points of realized volatility, and they're really, really, really boring. But if you remove 1 or 2 more points and you stay at 15, that's 6, 7 points VRP, that's even better. Now, that opens the question as to why do I think that my risk is on VIX going even lower? Well, because it's not guaranteed, especially with Trump around. The China stuff is probably out of the way, but the Iranian question is not completely solved. One day there's a deal, next day there's no deal. It looks like they're converging. They're converging somewhere, looks like it, but until it's fully signed and everybody has agreed, and you've seen that nice picture with people signing a piece of paper, it's not done. There's that lingering inflation question, that can come back. Maybe we'll not exactly see a 7.5, but maybe we'll see a consistently a 9 or something like this. But if we see a 9 and that stuff keep drifting to 12, um, that's not great VRP wise because you start to be really compressed. You have 3 points. So the question here becomes, uh, why is it more problematic to have 3 points of VRP or 4 points of VRP with VIX at 12 potentially than it is when you have VIX at 14, 15, and then RV at 10. Um, 3 points is not great because first of all it's slim, but when you have RV at 8, what usually happens is the market are particularly lazy, particularly slow, and they tend to drift up, right? So if you just go with strongholds, usually your core side is always the painful one. And in situation like this, it is often better to sell some lazy risk reversals than just trying to hammer the core side. But obviously that comes with a big gotcha, which is you have directional risk. You can argue that RV at 8, directional risk, is it really a problem? Probably not. But if we're trying to stay true to what we do here, yeah, we don't really want that directional risk. So it's not ideal. That's why first and foremost, I'm not first and foremost, yeah, if it goes to 12 and RV stays at 9, you have 3 points, it's manageable. You can make money with that, but it's not fantastic. So I'd much rather seeing it stay at 15. And RV keep going down. That would be fantastic. That would be perfect scenario. But otherwise, yeah, my risk is to see VIX over the next few weeks drifting to 12, and RV staying at 9, 10, and you have 2 points VRP. That's not amazing. The markets keep drifting up because uh, we're getting ready for those massive IPOs, astronomical IPOs. People are buying stuff, and you keep having to like recenter your strongholds. And then one day you decide that you go risk reversals. That's the day the market decide to go down. Now you have a bunch of deltas in your book. It's a bit annoying, to be honest. Um, the other thing that one has to take into consideration is, so obviously that's not the regime that we're in right now, right? But I often have the question of, okay, well, you have 5 points here right now at the moment, and when we had 5 points here about 1, 2 months ago, and you had RV at 16, 17, you were way less happy with those 5 points than potentially having 4 or 5 points here. Uh, it's obviously because, once again, you have to think in regimes and what do characterize a regime where you have RV at 10 and RV at 15, 16. the risk of jump and gaps is much higher at 16, 17 in SPY and in any assets really than it is at 9 or 10. At 9 or 10, for markets to back to gap up 2%, I'm not saying it cannot happen. It will happen once in a while, but it's just going to be once in a while. And okay, well, it's the variance game, right? You have to accept that risk. But overall, if you compute some sort of probability around it, I don't remember the probability at the top of my head, but it's very low. The minute you have realized volatility at 15, 16, 17, it's already much higher. So you can wake up one morning and the markets have gapped down 2, 3%. And that happens much more often when you have RV at 15, 17 than when you are at 9 or 10 or whatever. It's always a much safer environment. I would even argue that um, sometimes you have, I think we've seen that here. It's sometimes even safer to trade 4 or 5 points of VRP when you have RV at 8 or 7, like we have had over here or in the summer. Then sometimes where you have 8, 9 points VRP, but where RV is much higher and your risk of big move one side or the other is so much higher. Because what the big problem for us, it's not so much that the market moves. The big problem is that RV 18, yeah, you can have a move of 2, 3%. I don't know if you guys traded in April 2025, but you had moments where you would have a tweet of the White House. I will never forget that one, but the White House tweeted something on the Monday afternoon, after the first Monday after the Liberation Day. And then the market took something like 4% in half an hour. And I know the theory about delta hedging and all that kind of stuff. There's nothing you can do, and that was in market. That Monday, actually, I think we got down something like 5% at the open. Those are the kind of stuff where there's nothing you can do about. And even if you have 10 points VRP in what you're selling, and if you look at it from, well, the spread, but even worse, the ratio, right? You'll start thinking, okay, that's fine. I'm good. I have 30, 40%, whatever. But the risk is not really here. Your risk is what happens if there is one big move that I can't hedge. And when you're here, that can happen quite often. When you hear the risk of big movies is much lower. So I go back to what I was saying in starting of that call. It's a calm regime for a reason, right? I know we're going to open the FT tomorrow. They're going to say, oh, yeah, the deal's not done, blah, blah, blah. The bonds are saying something, blah, blah, blah. Okay. Yeah, I'm not saying it's not true. I'm saying that even if it's a possibility, your risk of gap when you're here is much less concerning. Doesn't mean you should become an idiot and not hedge or be mindful or potentially buy wings at the moment. That might be a good idea, especially for the back of this year or early next year now, because some of those contracts are. I know that a lot of you are trading MES. I think MES allows you to trade only 6 months further. So we can't trade early 2027. But I would start thinking about it, right? Like vol is low. It doesn't mean like just go all in right now because vol is probably going to keep being low over the next few weeks. But keep that in mind for the next few weeks, the summer. Yeah, just buy some. Make sure that the day you have that move or I don't know what Trump is doing or Iran is doing, at least you're much better. We haven't talked about vol of vol in a while, but it tells the same story. Uh, at the end of the day, vol VVIX, it's quite related, right? This one is just so VVIX is the implied volatility of VIX, implied volatility of pretty much VIX calls. This is realized volatility of VIX. As you would expect, is back to some of the lowest levels, right? As a reminder, this is where we were. I was very uncomfortable about 2 months out. It's a much different markets now. The way to read this is pretty simple. It's not the risk of seeing 3 points or 5 points of VIX up in session is gone, but it is significantly lower than when you were here. So I know that like, okay, you see 15, right? And you're gonna feel extremely uncomfortable selling it because if we just go back here, you see 15, you're thinking, oh yeah, it can go to 20. Of course it can. Um, but you look at the different statistics, the probability of it doing that right now, it's much lower. The regime is just not there. So if it does that, it means that either you have a very strong catalyst or you probably have a market that's overreacting about what's going on at the moment. Um, Obviously, your role in that situation is to make sure that you have a good grasp of, is it that big? Is it not that big? If you're wondering if it's that big, now we've had enough example over the last 2 years. Uh, does it look like Liberation Day? Does it look like Hormuz can be closed? If it doesn't, it's probably not that big. So yeah, like, I mean, I said that a few minutes ago, right? But honestly, if I see 17, probably gonna start loading up. It's definitely the kind of market where uh, don't sell 15, 16 and you don't have any dry powder anymore. But if you see 16 and it keeps going up to 17, 18, 19, it's definitely the kind of stuff where I'm just going to be selling them all. In this kind of market where you have stress, I'm probably going to be a little bit more careful about loading things up. But situation like that, I think it's a little bit safer. Let's talk about oil a little bit. It's relaxing, obviously. We've lost, I think, 8% last week. We've lost something like 15% in 2 weeks. It seems like things again are converging. You can also see that on the implied volatility. Um, what do we do? It's that weird situation where you remember for equity, April was like, okay, you have to keep it 1 week or 2 weeks before you can sell in equities again because implied has gone down a lot. You need to make sure that realize is also going down and don't get caught into that weird middle. I think it's a little bit similar in oil at the moment. You don't want to be caught in that weird middle where implied is low, realize is still high. You can still have those wild whipsaws, especially in the short terms. It can get a bit uncomfortable. So either you take them off and you come back when things are settled down, or otherwise, yeah, just I still don't think it's a terrible idea to sell vol at the moment in Uzo and oil in general. I still think it's overpriced. But yeah, you have to be mindful of the fact that I mean some of the moves this week were pretty insane, right? I think we've lost. Remember, I mean, not as in comparison to what we've seen the entire month of March, that was nothing. But I've seen CL move from 90, I want to say 92 in the front month to 88, and then the next day back to 91. Now we're 87. So realize is definitely there as the market is digesting news. If you put yourself at 30 days, you're probably going to be fine. But again, things are moving, so you don't know which strike can potentially be touched. So yeah, another way is you just push back even further in time, or you have to manage it a little bit more. And by managing it, not defending strike or whatever, but just recenter them, push them back in time, and you should be fine. Be careful with that super short-term stuff. This is the moment where you start to have and they're converging again. Like you never know. But it seems like after a few weeks of pretty much nothing and statu quo, no one was really talking. Seems like they're willing to talk a little bit more again. And then yeah, you have those 4 or 5 points. If you trade CL has almost daily contracts. You don't have them, I think, in MCLs. So you're probably less affected by that. But if you trade something that in Uzo, I think you have almost daily contract. If you come here and you try to trade stuff that expire soonish, same idea. There's definitely something to harvest, but the problem here is you're always gonna have the temptation. Let me keep it a little bit longer. Let me keep it a little bit longer, and then bam, you have a headline, and it's a little bit annoying. This is why I stand by to what I always say: take your profit at 25%, reassess. Does that look like the risk I want to have? Probably not, because now I'm probably short. I'm probably long too much data. Because yes, that's the thing. If you long too much data, you probably are short too much gamma. So take them off, push them by, push them back by a week or two. Give yourself the space and time to breathe. But resist the temptation to keep it up until the expiration. Because yeah, you wake up one morning and you're like, "Okay, what happened? What have I lost?" Well, it's just a new headline. And sorry, but yeah, just uh, just gonna have to pay the price for it. Um, That's it. I think, yeah, one last thing. Yeah, so SMH is there a little bit these days. SMH and the semis overall. The semis are an interesting one. There's definitely some VRP to harvest, right? You have, especially on your 20 delta puts, it's not crazy high compared to what we've seen over the last 3 months. It seems like the market is definitely buying more on the put side. As you can see here, right? It's pretty obvious. Once again, implied volatility is nothing else than demand and supply and demand. If you just We were looking at the VRP views a few minutes back. We look at it from a pure IV views. That's pretty much what the market is telling you, right? We're just buying all of those calls. We don't care. Give us those calls. We'll pay any price. So VRP is a little bit more often driven on the core side right now, but it's another subtle clue, right? VVIX is low. The market is buying some calls in SMH, a lot of calls in SMH, by the way, and not like 30 days out, right? It's the entire vol surface, even 2 years out. You put two and two together. Can we lose 5-10% in stocks next week? Yeah, potentially, but that's not really what when people are selling insurance and they're buying calls on arguably one of the most volatile serious asset. No offense to the others, right? But SMH and Sumis are not they're not meme stocks, right? So and they move a lot. So yeah, like we don't want insurance, and we want options, and we want calls on whatever happens in SMH over the next between now and the next 2 years, because we might have FOMO. So we're basically buying insurance on the upside. That tells you a little something. The one thing I thought that was interesting though is this curve. So whether it's the forward or the spot, they're completely flat. Right? And when it's completely flat like this, you also need to remember that it's pretty much a market that telling you we have no idea what's going to happen with the semis over the next 3 months, 6 months, 1 year. So obviously, you'll see a lot of conflicting views and information and whatever, but the truth is, this is the opinion of the market on the semis. It's we have no fucking clue, right? We don't know. Things can go really well, things can go really bad. It's not a contango, definitely not. It's not a backwardation. It's flat, like North Dakota. So yeah, the market just simply doesn't know. It's good. I insist on this. It's good to come back to those numbers once in a while. That tells you the market doesn't know when we are flooded with opinions and people thinking about a lot of stuff, because we're human beings and we have opinions. Obviously, we can be swayed by the opinion of others. But sometimes you have to go back to those hard charts and being like, yeah, but the truth is, like, nobody knows. Don't come argue with me and tell me like, oh yeah, no, the market is dumb. This is what's gonna happen. Blah blah blah. Like, yeah, I'm not saying you're wrong. I'm not saying your view is dumb. Might say some once in a while that some views are not particularly smart, but if you just go back to the collective view of what's happening at the moment, nobody knows. That's it. If you guys have questions, I'm happy to answer.
Hi, Alex. Thank you for
Yeah.
the call. I do have a question for you about VVIX, VXX, and this kind of stuff. And it's about with like VVIX so low, the shape of the term structure is one of the steepest I've seen recently in the futures term structure. How are you approaching VXX? Is it still worth it to sell calls? Maybe the underlying starts making sense. I don't know.
Yeah, absolutely. I mean, when you have steepness in the so it's funny because actually the last 2 weeks that's what I've been doing. I don't write those trades down, but instead you can be short VXX or you can just short the futures. And it's been indeed it's very steep right now at the moment. So you can just go sell some futures, some VIX futures. I was selling a lot of July futures. I tried to sell the front months. I didn't really want to do June because June, obviously, you're gonna have a lot of activities and weird stuff potentially in June because it's the semi-annual. There's a few expiries that matters and you want to be a bit careful. I think June is one of them. I think June and September you have to pay attention to them. March a little bit less. December maybe a little bit less, but yeah, June and December you usually want to pay attention to stuff that happens before. So usually end of November, first week of December, people rebalance their portfolios in weird way. You have weird moves in the market. June right now, yeah, try to be careful with June expirations. So I know that I'm shorting VIX futures in July because it's steep, as you said. You can short VXX because it's pretty steep. I just like to do that stuff myself. And as for VXX, I mean, of course, you can sell calls. In my opinion, you should just always be short straddles in VXX. And when it's steep like this, short your straddles in the sense straddles or strongholds, right? But just I mean, the truth is, I need to write an article about that so that you guys have the final proof. But the truth is, the best way to make money out of that stuff is just to be always in straddles and slightly under the money. You you make more money than selling strongholds. Strongholds feel safer. You cannot. We've been selling strongholds because things were moving like hell, and like I didn't want anybody to be where is my regime? Where is my regime dashboard? I didn't want anybody to get hurt in a place like that where you never know if something could really bad. But the most profitable position is to be short at the money straddles and slightly under the money so that your straddles is slightly negative delta. Um, and that stuff just goes up. And once in a while, yeah, you get badly hurt, but you have ways to mitigate that. So yeah, absolutely. It's pretty steep. Don't try to be a hero and be long vol here. It goes down, so just sell it. As I said, I mean it's consistent with what I just said here. Um, and that's pretty much also why I'm selling those VIX futures because I know that my risk is here. And if it goes to 12, well, what is my insurance right now if it goes to 12? Well, my insurance if it goes to 12 is by selling VIX futures. That's what I'm doing. So weird insurance, I get it because people are going to say, oh my God, but what if it goes to 30? Yeah, I know it can go to 30. I have other hedges for that. Your long wings in SPX probably going to be fine. You're probably going to have time to remove some of those futures. But yeah, if it goes to 12 and you haven't been selling VIX futures consistently over the next few weeks and months. Um, it's also a much cleaner way. We talked a lot about VRP, and maybe it's a little bit of anticipation to what we may be talking. Honestly, I hope not. I really don't like when it's like that low, 13, 14. But it's also a much cleaner way to extract VRP than trying to be in options. Because as I said in the call, when you have like 3 points. you have VIX 12 and RV9. Most of the time it goes up. So you don't want that directional risk. And often a much cleaner way to extract the VRP is just to go straight into the futures. But we're not there yet, so I don't want to drop the gun and say, "Oh yeah, you guys have to do this," because I don't think we're there yet. But yeah, that's something you want to keep in mind. Anyone that tells you don't sell VIX futures right now, I'm not saying they don't know what they're saying, but I don't think it's a particularly good advice considering what's happening right now in the marketplace, right? It's pretty calm and quiet. As you said yourself, fixed term structure is pretty steep. I'm not saying no catalyst can move the market tomorrow, but it's gonna have to be a really strong catalyst that no one has seen coming. So yeah.
Cool, Alex. Thank
Hey,
you.
hey, Alex. Yeah, I had actually a question to tag on to Miguel's question. With this VXX trade, I've been doing these straddles and striking them just slightly below where the spot is. But then, do you have any like what's happened to me a few times is that spot would drift lower, so I would end up with a like a negative delta and go into a positive delta. So I've kind of just closed them out, or I've been just rolling down my calls into like sometimes even an inverted
Mm.
strangle. So I don't know. That's been my way, but I don't know if you have any
So that's
what
that's
you
the
do.
kind of stuff. If you do it long enough, you'll find yourself in situation where yeah, it's crazy steep like it is right
Yeah.
now, right? It goes fast a lot these days because again of the steepness in the fixed term structure. It's probably the steepest, as you said, Mikael. It's the steepest fixed term structure we've seen in a while. So yeah, VXX goes down really fast. Uh, I don't like to I don't like to get the call down and then you keep the puts
Yeah.
because what can happen more often than not is you're gonna get a sign on the put side, and that's not something you want because anyway, it's going to drift down. So in situation like this, once again, it's a variance game. It sucks because you may not be making as much money as if that term structure was slightly less steep, but it's like this. Just do as usual. Don't try to overcomplicate it. Close the straddles and
Take it
open
off.
a new
Yeah.
one. What you want to do though is you may want to. So most of the time, I sell the strike underneath, but you can look at 30 days and say, okay, what if I sell two strikes underneath? Does that give me a little bit more leeway? Basically, am I adding even more negative delta to the
Yeah.
position? Um, that's the kind of stuff where obviously it's the discretion of everyone, and yeah, you're adding discretion in the decision process, but it's not an unreasonable decision for me to
Okay.
say we're trading 24 right now. Don't say that you're going to be selling the straddles at 20. I think it's very unreasonable. But if you say I'm selling straddle 22, it's not completely crazy to me because 30 days out, right? Not in 2 weeks, because yeah, it can happen. And yes, he goes to 28 tomorrow, you screwed. I'm sorry, but again, it's a variance game. In a situation like this, most of the time it's going to go down. For it to go to 28, it's possible. That's really not where the odds are at the moment. If it happens, then we just know what to do because at the end of the day, it's probably going to come down and drift back to 25. So we have different way of managing it. But try to avoid that. Like, oh yeah, I'm just keep rolling my calls.
Yeah.
Just go recenter and open another one, open more even, something. It's always a bit scary for me to say that in this kind of calls, but obviously I'm not responsible of you guys' risk. You manage your book the way you want to. I'm just here to give you the edge and what I might do in situation like this. But uh, yeah, I'm personally gonna be opening even more VXX straddles for the good reason that you have less premium, so you want to keep collecting premium, obviously, but also because the realized volatility in VXX is pretty low. I mean, we don't even have to open that one. We can just stick to this.
You
It's not
you
going to
find
be more.
yourself. Do you find yourself sizing up slightly though in terms of
Yeah,
total amount of units?
yeah, yeah,
Yeah, okay. Yeah,
yeah.
I thought so.
Yeah, like it's I again, I'm aware of the risk. I know some people will look at that video and say this guy is completely insane. Uh, I'm not insane in the sense that I'm not doing that completely naked. Once again, I have a ton of SPX puts pretty much all the time, pretty further away. Yes, I'm aware of the fact that VIX can go up and doesn't necessarily translate in yes going down. However, even more in the markets like this, right? That's pretty much August 2024. It's extremely unlikely. It is likely that you'll see VIX go up here and ES not go down in a market like this. It is extremely unlikely that at RV8 CAM regime that you'll see VIX go up back to, I don't know, 1920 almost overnight
Yeah, not in a session.
and no reprice on ES. It's possible. I've never seen it happen. I mean, that would probably be something that looks like Volmageddon or whatever, but it's extremely unlikely. So yeah, like yeah, size up. But again, keep thinking of the globality of your portfolio. If you do this, it means
Of
that
course.
you're comfortable with the level of insurance you have in the back. I talked about this in the Discord actually this week. Nimish is not there, but yes, something that I do in situation like this is I buy zero DTs, zero and one DTs. I buy the one, two deltas. They cost. I usually pay. I like to pay $1. It's really lottery tickets. You pay $1 for your puts, something like half a dollar on your call side. I mean no, one not $1. It's 1 point, one ES point, half a point on the call side and you buy that on the 0 and 1 DT because like yeah you never know markets just open caps up caps down 2%. You're not gonna be rich with those options, but again it's an insurance, and instead of looking at VXX and being really annoyed because now it's back up, you're like, well, at least I have these things. They don't pay often, but once in a
Uh,
while you're quite happy to have them.
Like how far of the money would those be? Like would you like a half a point or 1 point
Well,
of the
that's
cost?
that's literally delta one. I mean, not,
Yeah,
I mean,
okay.
literally one.
Okay.
So how far is that? The last one I bought, I was buying this weekend. Usually these days, the last week I was buying a lot of stuff around 7,300,
Okay.
7,250, 7,300. So it's like okay, in one zero, one DT, two DT, it's basically if we lose 2-3% for whatever reason, right? It's nice because if you go longer, unfortunately, um, you become, I mean, by definition, right? You need a much bigger move. You're gonna look into something that looks like 4-5% move, but 4-5% move in 1 week out or 2 week out, it's possible, but it's definitely more expensive. You don't have enough Vega really to pay up for something like this. It's not great from a
Yeah.
gamma ratio perspective. But yeah, 0-1 DTs. I mean, again, it's a terrible thing to say, but pretty much all the options that people would be very happy to sell on the retail community side. Often, unfortunately, retail have it. I mean, we are retail, so I always feel a little bit bad and sad to say this, but yeah, no, don't sell those options. I know a ton of people are selling the one, and they're like, oh yeah, that's great. Here is 1 point of yeah. I personally think it's a great insurance. I'm buying them. So
One last question that I had was about USO because you talked about it earlier. Are you happy selling the puts there still to make it delta neutral, or you just focus on the calls? You just do the call.
no, so with what's happening last week, so my puts got pretty much. It wasn't great last week because my put I had 90. I have a lot of 1985 and 80s in put in CL. So obviously those are becoming into the money. I think CL. I'm probably gonna. keep on the call side for sure, but there's um there's the question of where do you sell your. I think it was, so let me say this. You need to keep selling puts, but are you going to be selling 20 deltas or 10 deltas and basically allow that stuff to be a little bit more skewed delta wise, to allow potential drift down because it seems like we're converging towards a solution? Are probably going to be doing this. I don't know how what I'm going to do with those. I mean, some of them that I have, they're supposed to expire in about 3 weeks. I probably should be able to exit them because uh, you might have one of those last hiccups, and then I'll probably get rid of those. I think you need to, again, we're delta neutral, right? So you need to keep selling those puts no matter what. Now the question is, do you sell them delta 20 or do you allow yourself to go to delta 10 because you know that things are going down? I'll probably go to delta 10. That would be 80. But then we switch contract in CL, so I don't know what it's like in the August contract, what 80 is gonna do because you probably lose 2 3 points. So yeah, but probably 80 75. Probably gonna be selling those. Probably already in those, by the way, but I don't know all the prices. So yeah,
Cool.
Alex, can I ask you something quickly?
absolutely.
Yeah. If you're shorting the straddles on the VSX alternative hedge, could that be to buy the VIX futures, maybe the far out ones? I don't know, August or something.
Okay. So August is not far out. Um,
September.
so by definition, so let's put it like this. By definition, you always sell the first 3 months. Should be comfortable saying the first 3 months. If you sell the first 3 months, you could be buying the one after. So yes, September might be okay, September, October. But again, that's not the best hedge to me to this kind of situation. I mean, it is, but here is what's gonna happen. If you have a problem for whatever reason, you're gonna have your term structure that's gonna well reprice, and it's gonna be this that's going to go up by a lot. This around here is obviously going to go up, but not by that much. So this is going to go up by a lot. This is going to go up, move a little bit, but not enough to really constitute what I would say a strong edge. Um, I still think, and maybe I'm wrong, and maybe it's the kind of stuff where it's personal preferences. I still think that owning cheap options in SPY is a better solution than getting into VIX futures that ultimately always go down. Um, because they will. Even if you have something happening in the front, that stuff is gonna go up a bit, but then you will need your term structure. You will need that catalyst to be strong enough for your term structure to really completely switch and that stuff to keep paying. But then in that case, you really have a bigger problem on your end anyway because you have that stuff here. So I'm not saying it's a terrible idea. Like if you're looking for hedge, yes, September VIX futures, you can probably be long. If you sell the straddles, I guess you make money this way. I am personally more comfortable with um, go buy some
Puts.
SPY puts and stuff like this. You
Okay.
always have the nice advent. First of all, they're filled with Vegas, and you always have the nice possibility of it's a matrix, right? Like VIX can go up and yes, not react. And we've seen that not last week, but the 2 weeks before that, where markets were going down and VIX wasn't exactly moving. So you always have that nice perks with those options where sometimes the market goes down, VIX doesn't exactly react, your VXX stuff are kind of like moving up, but they, especially the last 2 weeks, right? It was really funny because VIX structure was still pretty steep, so you would still see VIX going down, the futures going down, VXX go down, and still the market go down. Not last week, but the week before. That's not the norm, but yeah, you can see a situation where VIX barely go up or go up a bit. You're a bit annoyed on the VXX, mildly annoyed, but then for some reason markets lose 2-3%, and then you have this stuff, especially the short DTs. Not saying you're gonna get rich with them, but it's always nice to have them a little bit in green, and then you can just pocket some of them. I think that's better than trying to get long the futures.
Mm.
September, you might not have any problem with liquidities. I'm always bad at that game because I trade the calendars, but that's also something you want to keep in mind. I don't know what spread you're gonna get in the 4 months VIX futures. If you
It's
try to
pretty
get in and
horrible.
try to get out.
It's
Hmm?
horrible. It's horrible.
Yeah, exactly. I'm not surprised. So honestly, it's not a terrible idea, but I don't think it's the most efficient.
Yeah, and just to follow up, you say rather than doing the VIX futures, buy the SPX puts, for example. How far are we? Are we going to like 5 delta? And are we going far out then again, or are we?
So that part, like it's the usual stuff. Go 6 months out,
5 delta?
right? For 5 delta is you need a big move, right? Like usually like 20 is a bit expensive, 5 is too cheap. Go somewhere between buy strips, right? Between 8 and 15. Some days I buy 20, some days I buy 5, and then you one day like okay, you have a big move, but 5 is a bit you can't basically you can't have just delta 5. You need to have some that are much closer to 20. But if you just have delta 5, you need a massive move down to see this stuff start paying out. They don't have a ton of Vegas. They obviously have a little bit, but they obviously have little deltas. So you basically these ones are very reactive to strong movement in implied volatility. So if you have like a catastrophic event, right? Like I don't know, tsunami overnight or some weird attacks or whatever like this, then yes, they will pay off. But if you just have a slow grind down and like, just few weeks of people getting all crazy about AI and bubbles and stuff like this, you might see market lose 2-3% and this stuff barely react, and you'll be like, what's the point of having them anyway?
Mm,
It's not even better. I'm not saying that like you will see a much better protection at 15, but for retail traders, you don't have risk managers behind you, and you need to remember that it becomes a psychological game and a psychological game against yourself. If you see enough times your delta 5 not pay off, there's gonna come a time where you're gonna say, why am I buying this stuff anyway?
right.
And then the day you will actually need them, you will not have them in place.
I
So
see.
it's better to have them at 15, see them bleed, but see them once in a while getting green, so that like you kind of see them working,
Mm,
so that you're like, okay, well actually I have that stuff. And I insist on this. We talked on this on the Discord last week. Again, when I say hedge, it's not just to put buy both sides, uh, especially when things are quiet like this. The risk is on the call side, right? Like, so if you have, I mean, I've been unloading a shit ton of calls in SPX and ES the last few weeks, and that's all what I'm gonna be doing again the next few weeks because, yeah, I mean, now I have a bunch of stuff that are in the money that's shifting all your risk profile. Um, but the risk is both ways, right? Most people see it on the downside, but when we were here, right, and everybody was concerned about Iran and starting to talk about inflation, and you had that talk about credit, the potential credit crisis, and you open social media, you listen to Andy Constant, we're going to 6,000, right? Here, 6,000. Well, what if actually the risk is to see in 1 month and a half, ES 8,000? That's also a risk. And now we're here. And if you were not hedged, then you're paying the price for it. So don't just buy the puts, always also buy the calls.
Yeah. Okay. Thank you for that. I also wonder if shorting the SPX futures, ES futures, or something might have been an idea as a
So it's
coach. Anyway.
so anything in the market has to come up with, when you build a book like this, it has to come up with a justification. A short futures in ES is not a stupid idea. Once again, if you have too much deltas, for instance, if you're too long, because again you're in a situation where you've bought a lot of calls by just construction of buying strongholds, right? You buy those you buy those 4 6 months strongholds early in January. Now your legs are really green on the call side. You have too many deltas. Well, you should monetize them, right? But sometimes, for whatever reason, you don't want to monetize them. That can be clean and quick enough to just sell a futures. That works. Selling a futures comes with problems. That's a Delta One product. So you always need to keep that in mind. And whichever book of options you manage, when the market keeps drifting, the Delta One doesn't go away. So you either need to keep selling puts all the time or buying some calls and basically kind of harvesting the skew, right? Because you're basically buying a risk reversals and you short your futures, and you're basically harvesting the super expensive put. But if your books allow it, why not? But now if you tell me I'm delta neutral and I'm trying to hedge volatility risk and I'm selling VIX futures, sorry, ES futures, I'm gonna tell you like, no, that's probably not a good idea, because all of a sudden you become super short the market, and that's not what you want. And even if you're a little bit positive delta right now and you sell futures and you become delta neutral, I'm gonna tell you like, do you really want to be delta neutral right now? And if you're delta neutral, what's your gamma profile? In the sense that people love to overcomplicate gamma, but if the market takes 5% tomorrow, what is the delta of your book? Is it positive or is it negative? If you're short gamma, it's going to be negative, which means you're going to have been bleeding money all the way between 0 and that plus 5%. So you probably don't need to short that ES futures. Just you're already short gamma. You don't need that futures. Let your delta exposure goes down as the market go up, and then rebalance in 1 or 2 week when you want to rebalance your weeks overall. Shorting ES futures again, it's just a tool.
Okay. Thank you.
You're welcome. All right, cool. There's something else?
There's a question in the chat. I don't know if you wanted to
Oh
touch
yeah,
on it.
let me see. Maybe a question I don't really understand, but what if fall goes up and SPX where it is, one tiny put for edge be not very beneficial? Yeah, we talked about this. Yeah, I agree. That's what I was saying to Sam. You you don't want, that's why I don't like to call them tiny puts anyway. I'm not saying you should always pay 15 deltas, but buy strips. I always say that buy strips from 1 to 20, 15, somewhere around there. Uh, and don't buy strips all the time. But every week you should be buying option, and maybe this week you buy 15, maybe next week you buy 5, maybe the week after that you buy 10, and in different expiration. And you'll see that overall you have a book that's a little bit more resilient. But if you buy just Delta 5, yeah, as I said, and you're right, absolutely right. It's not particularly beneficial, because you'll see moment where the market's going to go down 2%, and your puts are still going to lose money, and you're going to be like, what's the point of having them? And then you're going to stop buying hedges in those longer months, and and then you have an August 2024, and you're like, "Oh, fuck, why didn't I have that stuff?" And that's not the position you want to be in. So yeah. All right. Thanks, guys. I speak to you all in the Discord.
Merci, Alex.
Thank you.
Merci. Bye bye.
Thank you.